Good morning. Welcome to Stock Market Today for Thursday, January 23rd, 2020. This is your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email that hits your inbox every trading day before the market opens. And before we get started, just a quick programming note. Next week, Monday, Tuesday, Wednesday, I will be out of town on a business trip, and Stock Market Today will not air. Let's dive in now. U.S. equities finished a little changed in Wednesday's trading. Technology, utilities, and financials outperformed, while energy and REITs lagged. Treasuries were mixed on the day. The dollar was flat on the yen cross and weaker against the euro. Gold finished down 10 basis points. WTI crude was down 2.8%. What's interesting to me is thus far the market has remained resilient in the face of some of the concerns that we've seen in the early going of 2020, the tensions between the U.S. and Iran, and now the outbreak of coronavirus in China. And as we get to the desk this morning, S&P futures are they're mixed to slightly lower in early trading. Asian markets were lower overnight. China was down 2.5%, Hong Kong down 1.5%. European markets are mixed. Treasuries are stronger across the curve. Dollar is weaker against the yen, but stronger against the euro. Gold down 20 basis points, and WTI crude continues to head lower, down 1.6% in the early going here. So the structure of the S&P 500 remains very much intact. We're holding near record levels, and as I said, showing a lot of signs of resiliency in the early going of 2020. Near-term support remains in that 3,200 to 3,250 range, and we're still looking for resistance levels to form. I mean, if you really look, S&P 500 traded at another all-time high yesterday before fading into the end of the day. RSI is in bullish ranges and does remain overbought, and Chaikin money flow is bullish. So our indicators continue to confirm the uptrend in prices, so we continue to stay the course. We've given you the key levels. Above those levels, I think it makes sense to continue to focus on leading stocks and leading areas of the market and manage your risk, as we always advocate. Let's hit our market in a minute. What are we writing about today in our note? Well, we remain resilient in the face of the virus outbreak in China. Breadth metrics continue to support a bullish view on equities. It's Thursday. We look at market breadth on Thursdays. Value lags the broader market to start 2020. Materials continue to underperform and actually have a bearish rating here at Chaikin Analytics, and futures mixed to a slightly lower open here today. Our power bar ratios now for the major indices. Dow was, let's call it flat, but the ratio took a slight dip, still bullish, 7 bulls to 6 bears. S&P 500 also relatively flat, 143 bulls to 56 bears there. NASDAQ was an outperformer. Thank you, strength in semiconductors, which we're actually going to look at a little bit later in the show. NASDAQ adds 26 basis points, 35 bulls to 6 bears there. Small caps underperformed, still skewed in favor of the bulls, 633 to 222. Bonds moved higher, sending yields lower. We've been talking about that a lot over the past couple of days. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain bullish, but the major markets across the board are mixed. Let's look at our stock of the day now. Remember, the stock of the day is auto-generated based on the Chaikin Power Gauge rating, and it's Jazz Pharmaceuticals, one of the pharma stocks. We've been talking about pharma a lot lately. Closed at 150.47, up 8 basis points yesterday. Jazz has a very bullish Chaikin Power Gauge rating due to very attractive financial metrics and strong earnings performance. Weak price volume activity and negative expert activity come into play here, but the 20 factors, 5 in each of these 4 categories, give us that very bullish rating. Stock is in a strong trend above this rising long-term trend line. It's in a strong industry group. Again, pharmaceuticals, one of the areas within the leading healthcare sector that have been doing well. So when I take a look at the structure of Jazz here, what I see is a very bullish stock that is still outperforming the market. Now, the intensity of outperformance has diminished a bit of late as the stock has consolidated, but still an outperformer. So a very bullish stock outperforming the market and model in agreement. Chaikin money flow is bullish, consolidating above this 145 breakout level. Really, for me, the only concern I have is that we're overbought at the time being, right? Our overbought, oversold indicator, it's a short-term indicator, but it is overbought. We want to find names like Jazz when they're oversold, right? Down here, when they're oversold, when they're bullish and outperforming and oversold and money flow is bullish, that's your ideal entry point, right? I think for now, the best situation would be for a continued consolidation above the 145 level that works off that overbought condition and then sets the stage for a much more compelling entry point all else being equal. So, if the stock is still very bullish or bullish, still outperforming, and still and that industry group is still doing well, then Jazz looks really interesting to me. For you breakout traders who want to look at 145 and call it the breakout level, we've had a breakout or retest and now starting to move higher. If that's your style, I can't argue with getting involved. If you're following more along with our process and you want to wait for that oversold condition, that's a viable option as well. Either way, I think Jazz is an example of a type of name we want to consider owning. And then stick to your process for whether or not you want to own it now or wait for that oversold condition. Let's look at our sector tracker now. The movement of the major sectors over the last 5 days. So, short-term performance. Utilities at the top of the list. Utilities have been on fire of late, largely coinciding with the 10-year yield fading. Remember, we looked at that chart of the 10-year yield yesterday and showed how it was starting to break down or continuing to break down after fading from the roughly 2% level. So utilities doing well in that environment. Technology, largest weight in the S&P 500 in the number 2 slot. Comms, remember a couple weeks ago we started talking about the emerging relative strength in comm services. They continue to do well on the heels of some big names within that group. Real estate benefiting from those declining yields. Rounds out the top 4 groups over the past 5 days. Now, middle of the road, discretionary staples, healthcare, and fins are all higher. Financials have really seen their relative strength come under pressure with rates, despite the fact that banks have put up earnings that are, roughly can be considered well received. What's lower over the past week of trading? Well, materials, industrials, and energy. And this is kind of interesting to me because, when growth started to outperform value at the end of last year and people started thinking about this cyclical trade coming back on, these areas of the market started to perk up. Now we're seeing value begin to underperform, and these cyclical areas of the market are beginning to fade. It's an interesting dynamic here. We're going to take a look at value a little bit later on in the show. But first, let's look at our industry in focus. And longtime viewers of this show know the importance that I place on semiconductors, right? Semiconductor services over the past 6 months has outperformed the S&P 500 by 9.2%. The power bar ratio, which measures future potential, is very strong. Got 10 bullish or very bullish stocks for only 1 bearish or very bearish stocks. And it's ranked number 5 of 21 subsectors, having moved up 7 slots over the past week. So some of the indicative names there where you may want to do some more work. Intel, what I will say is that Intel has a very bullish rating here at Chaikin Analytics. They are scheduled to report earnings today. Synaptics, SYNA, also very bullish. This was actually a recent call out from Mark Chaikin in his weekly note to our clients. And Corvo, QRVO, also with a very bullish rating. Let's take a look at the group here. XSD is the fund we're using. Bullish ETF power gauge rating, strong trend above that rising long-term trend line. Bullish fund, outperforming the market, intensely bullish money flow. Again, the only issue I see here is that it's currently overbought. But for me, I like to use semis as a data point to inform my view on the likely path of the general market going forward. And when semis are outperforming the market does tend to continue to move higher. And that is the case. Semis continue to outperform the broader market. So that's a positive data point if you are bullish on the market, as we are and have been. So continue to watch semiconductors. A lot of the leading semi names are currently overbought by our work. We've been highlighting them a lot. I think it makes sense to continue to focus on them. And when you see the stocks that are very bullish and bullish become oversold with bullish money flow, that sets up a compelling entry for individual ideas within this space. Let's hit what's trending now. Yesterday's S&P 500 movers and shakers. Cap 1, earnings sent the stock to a 52-week high, up 4.47%. BLL, didn't see any real news there. Stock higher by 3.75%. Intel, the chips were strong yesterday. Intel traded at a 52-week high, but as I said, they do report earnings after the bell today. IBM, earnings and guidance sent that stock higher by 3.4%. And ETN announced that they were selling one of their business units. Investors apparently like that. Stock higher by 2.8% on the day. On the loser side of the board, MOS. I didn't see anything company specific here. Lower by 5%. Zions, earnings report and margin commentary sent that stock lower by 4%. FTI, didn't see anything company specific there. Part of the energy complex, though. Oil was much lower yesterday. Netflix lowered their guidance, reported earnings yesterday. Stock lower by 3.5%. And CF, didn't see anything new to drive the stock yesterday. However, I do note that they did catch a downgrade here today. Stock was lower yesterday by 3.5%. Let's look at the charts now. Breath continues to confirm the price trend, right? If we're starting to, if we're going to start to worry about the market, we'd expect to see a breakdown in some of these breadth metrics across timeframes, and we're just not seeing it yet, right? And this holds true across timeframes, right? If I take a look at the percentage of stocks in the S&P 500 that are above their 200-day moving average, respectively, we're still over 80%, right? We've had this breakout level coinciding with the breakout in the market. For me, anything above 60% is a sign that a healthy majority of stocks are in long-term uptrends. If we break below 50, that would really start to get me nervous. Additionally, if this indicator started to make lower highs as the market was making higher highs, that would be a wake-up sign as well. So right now, in the long-term picture, we are not seeing the types of breakdowns that would concern us. Same goes for the intermediate term. Take a look at the percentage of stocks above their 50-day moving average, holding above this breakout level. 76% of stocks in the S&P 500 currently trading above their respective 50-day moving averages. So the intermediate term time frame rather, also confirming the price strength that we're seeing in the market. Again, not seeing the breakdown there. And we can take it a step further if we want to. We can take a look at this percentage of stocks. I do this in my note. Percentage of stocks above their 20-day moving average, so a much shorter time frame, and where you'd expect to see the breakdowns occurring sooner. Well, 66% of stocks in the S&P 500 are currently trading above their respective 20-day moving averages. So whether we're looking long-term time frame with the 200-day, intermediate term time frame with the 50-day, or even a shorter term time frame with the 20-day, breadth still remains constructive. Now, I've heard a lot of commentary about how leadership is narrow. Yes, the bigger stocks are outperforming, but if we look at the advanced decline line, right, for the S&P 500, actually made a new high with the index this week and is in a steady uptrend. So, a lot of participation to the upside for the equity market here. So breadth continues to confirm the price trend based on the work that we are doing. Taking a look now at that value, what we were talking about here with value beginning to lag. Here's the Vanguard S&P 500 Value ETF, ticker symbol VOOV. Right, what we see is a nice steady uptrend, right, on an absolute basis above the 200-day moving average, the RSI holding in bullish ranges, small negative divergence here. But what's jumping out at me is the breakdown in relative performance, right? Value started to come on in the fourth quarter of last year, had a nice breakout and was moving higher. That coincided with the move higher in rates. People started to think about the cyclical trade, right? People were becoming less concerned about the global growth environment. One of my views is that when investors are concerned about global growth potentially slowing, as we were for the bulk of 2019, they will tend to bid up growth stocks, right? And then as that growth concern started to fade, people rotated out of growth stocks and into value. Well, part of the thesis now, or part of one of the data points now, is the potential for the coronavirus, if it spreads further, to start to impact global growth. So what are we seeing? We're starting to see value come off and growth begin to outperform. It's an interesting dynamic at play, and it's something I like to think about when I'm looking for ideas in the market, right? Part of being in the leading areas of the market is understanding what sectors or what themes are outperforming and which are underperforming. And value is underperforming in the early going of 2020. Despite this uptrend, what this tells me is, yeah, value is going up, but it's not keeping pace with the broader market. You can see that breakdown here relative to the SPY. And one of the areas of the market where we continue to want to avoid is materials. Take a look at the XLB, the materials SPDR fund, right? Holding above the breakout again on the absolute basis, above the 200-day moving average. We do have a negative divergence, a series of lower highs with the RSI, but take a look at the bottom of the chart there. Look at that breakdown on a relative basis, right? If you're looking for strength in the market, you are not looking at materials. You're not looking at energy. XLB has a bearish ETF rating here at Chaikin Analytics. We continue to avoid. And again, just a reminder, you can take us for a test drive, sign up for a 14-day trial. I'll be back here tomorrow.